So now we're recording because it's July 13th. It should be a Friday the 13th, Michael.
Dun, dun, dun.
I know, because you, like I, woke up to all my investment friends' status updates about the Bank of Canada moving things up by a full 100 basis points, which surprised me. I thought we were going to go 75 basis points now and another like 50 or 75 at the next meeting. But apparently there's a fire and it's the only way to put it out.
Yep,
So,
kind of felt the same way too, to be honest with you. I was expecting 3/4 of a point. I was actually kind of thinking even a half a point because I thought it would be slow. 3/4 of the point was what I was thinking, following suit to what the US was doing. But to see what they've done is obviously telling you how big of an issue we've got in front of us, right? So
I think that someone at the Bank of Canada has finally actually realized that core inflation skips a lot of important things that are inflating a lot higher than 8% or whatever the state it is.
Yep, I agree.
I'm taking time today. I said just before we started the recording that I just, I do this every time something crazy happens. I like to talk to people that are older than me and more experienced than me.
What are you saying? That I'm an older guy, old guy? What? I don't know.
You're older. You're more experienced, Mike. When the Great Recession happened, when like asset-backed commercial paper collapsed and everything went bananas, I literally remember calling my grandfather that day to be like, "What the hell do you do in a recession? Because this is going to be bananas." I didn't even think of that till now. So we've both bought real estate when rates were much higher, and have both taken advantage of rates that were much lower. I suppose we should start with the small stuff and then go to the big stuff. You have a portfolio that's some apartment buildings, some single families, some condo townhouses. In the last month or two, or even today, are you making any changes in your portfolio or how you're financing things? Or what you're going to do in the near term for acquisitions?
Yeah, I think I think the first step for anybody when you've got an announcement of this size is, first of all, calm down, take a breath, right? Yep. And it's all about not getting emotional. And we've talked about this a lot. It's about using this right here versus using this and immediately pulling the trigger on things without taking the time to kind of assess. And you know what? I'll tell you right now, with this announcement, I'm going to sleep really well tonight. I'm not really going to be stressing out too much because, like you've said, Chris, it's like been there, done this before. And so, and it depends on how you kind of look at a lot of this stuff. I think the important part is for those that are investing, it's just like, take a minute, treat this as a business, no different than anybody else. Us as real estate investors, we buy properties, and then there's going to be companies that are literally all across this country that are taking this information today and they are assessing their business. And that is actually my first tip, and which is what I'm going to be doing. Today was one of my days that I meet up with our property management companies throughout the country and just kind of touching base. And after we did our kind of review, we talked and just said, listen, giving you guys a heads up, rents are going to go up. All of them are going to go up. I don't really care. And that's the first thing that's going to happen. And for us as investors, if you've ever been contemplating or being concerned, and again, stop with this, use this a little bit, and it's like, all of these costs are going up. And so it's important to make sure that you're mitigating those costs to the best of your ability. And the first thing, no different than what's happening when you go fill up your tank of gas or you're buying your 4-liter jug of milk. Prices are going up. It's all over the news. Your tenants are going to see this and they're going to know this. And it's just yet another thing that's going up. So my message is raise your rents. Like it's just part of the process right now. If you're trying to absorb all this stuff, you're just going to feel significant pain, because the problem is today, and I don't know if anybody's got a chance to read the announcement, and for those that haven't, read it.
No, I haven't yet.
There's more to come, and so we're not done yet. And so and depending on the market that you're in, you may be only able to get that one increase this year. Are you budgeting for that at this point in time? And if you can't get it, make sure that you're managing that part. So I know for us, that's the first thing we're doing. Secondly, are we doing anything with our financing? We're probably going to explore it. Some of it, it really has no impact. And of our multifamily properties throughout this country, most of them are fixed rates anyway. And Chris and I were joking around a little bit about this before the call. It's like, I'm not really sweating this one at all. I've got some of my multis at 1.9% or 1.8%, the other one at 2.3, and a few others all kind of in that range. It's just like, hey, there's no skin off my back a little bit. That's all great.
Totally. Right? When I put sorry for interrupting, when I put our loan on my multi here, it's a 10-year, it'll expire in 2030. And I said to my partners, I want to go for the 10-year because I don't want the renewal risk at the 5-year mark. If rents are down, there's a cash call. And if it goes the other direction, which is inflation and higher rates, we're going to have this beautiful asset that people want to buy. And the latter case is proving itself out true. And I'm starting to see rents increase in Edmonton. So
yeah, it's going to happen. And I think, my dialogue is, for all of our investors, we're all surrounded by our own communities as well as myself. And like, we all have to talk. And, Chris is an investor. I'm an investor. I'm telling you, I'm raising rents. I hope you guys follow suit. So in conjunction, everybody works together and we're all doing exactly the same thing. We tend to send the market appropriately because that's really what needs to happen. And we can't continue to absorb it with all these other cost increases. It doesn't take much. You go look at your insurance premiums. I was looking at one that's getting renewed today, and holy moly, it's just like, at some point in time, you're going to have to do some of those things that you need to do, because we all got in this game called real estate investing, better our lives, and not get into a debt. So take the time to do it and treat it like a business. I was kind of referencing is, when it comes to the finance side, there are some that we will relook at. And we may be extending some of the amortizations, because this game is all, from my perspective, in my opinion, and the way I like to manage it, it's a cash flow game. And that's the way I like to look at it. And I'm trying to preserve that to the best of my ability. And if I have to extend the amortization to do so, I'm happy to take a look at it. And if interest rates go down the road, I'll offset again just to pay more into the principal side if need be down the road. So I'm okay with that. Right?
Totally. So, and that's a terrific tactical tip. And Erwin Cito from Hamilton had a similar comment today that, and I have one townhouse I might think about doing that. If you can re-extend your amortization, it's great. He's got a couple loans where they were able to convert them back to an interest-only facility. And yeah, you're going for the short-term gain at long-term pain, because you're not paying down your principal. But if it helps you, especially if you've got a property that's negative or neutral cash flow, if you can do that, it's really going to protect you in the short term, as long as you're banking any extra, so that you've got more safety in terms of your reserve fund there.
It's exactly it. And like I said, it's about, it's a managing the business, guys. And that's the key. It's just like, take the time, really reassess it, look at some of your options. And again, for me, we've been through this before, Chris, being in Alberta, when you say recession in Alberta, it's just like, oh, just another one. It's just kind of one of those things where, it's so kind of used to this already, because we've already had to go through a few of these, that it's just pivoting. It's just adjusting. And again, looking at it and what are some of those things that we can, really preserve the business and the cash flow side of things to ride this thing out. And let's be very, very clear. They're doing this to temper inflation, and they're expecting recession to possibly happen. Once things get tempered down a little bit, I don't know how long this is going to take, but at some point, and again, this is my opinion, take it for what it is, I think they will start to reverse course at some point in time, but it's not going to happen right now. They're needing to temper down inflation. Once they do so, I would imagine interest rates will probably come down, maybe not to the levels that we were just a short 90 days, maybe 120 days ago. But you know what, I do expect things to kind of get adjusted, right? So
yeah, I've been seeing the same type of thing. And I have some guys who right now who are buying significant assets in cash with the plan of refinancing 12 or 18 months from now, that we'll go through this. And I'm actually, now that the 1% is out for that most recent hike, it kind of makes sense, because it's a really kind of a blunt policy instrument that we've eased off quantitative easing. And we already saw that come through the bond market before. I think they have to try the most aggressive tool they have in the most aggressive way, just to try and see if they can make a dent. I think that incremental changes, we're not going to have any impact on inflation. The thing I wanted to explore a little bit with you is that, I'm an Alberta guy. I used to own in Kelowna. We sold that. This is where I own. This is where I do all my business. You live in BC, you own there, you own in Alberta, you own in the Maritimes. My expectation as the Bank of Canada cranks the rates down is that it is going to push us into a bit of a recession. And I know historically, when we look at the cause of house price declines as one real estate metric, in BC and Ontario, it's essentially always been due to higher interest rates. And in Alberta, it's essentially always been due to collapses in energy prices. So I'm expecting personally that we're going to see this uneven recession. I mean, in the Great Recession, Alberta had, I think, only 2 quarters of negative growth, and then we were back to the races. And BC and Ontario took a year and a half to come back. So do you think we're going to see that same sort of uneven consequence?
I do 100%, to be honest. Well, I should say 100%, 98% of the time, because I think, the reality is, Vancouver and Toronto has been inflated for a very, very long time. Again, my opinion based on it, but affordability is going to be the biggest driver from my perspective, that's going to be the biggest driver of all of this. And so when you're seeing all these interest rates going up and people's incomes are not keeping to the same level, and the affordability that we've seen in the Lower Mainland in Vancouver and also in Ontario, or in Toronto specifically, it was already up to this point already. We had people that were extremely in a real high level of debt. Yeah. And now all of a sudden people are, these rates are going up, inflation, everything's going up. And now people are kind of like really struggling. There's a lot of concern in this marketplace right now, lots. And I haven't gone outside today yet, to be honest with you, but so far I don't see anybody freaking out just yet, but I have to just maybe walk around a little bit and we'll see. But I can guarantee you one of the things that I'm noticing is, even before this increase has happened, is people are looking at places that are more affordable. And so I think you'll even see some migration trends that are going to possibly happen. So that's kind of my sense. And, based on what we're seeing, and, we keep a close eye on any of our vacancies and where people are moving to. And we're seeing a little bit of an increase of people moving into markets like Alberta because, hey, I can buy a house there for $500,000-$600,000 and it's a super nice house. And my life is a lot better versus trying to afford this mortgage that's, $1.5 million, which is kind of like your average home in the valley, right? And so I think some markets are going to adjust. Like I actually I'm really interested in this in the next 6 months. Because and again,
I have a client who is literally on the road. Like he's in an Airbnb in Red Deer. Multifamily investor was living in Montreal. Is moving into his new place in Calgary this weekend. There are political and Quebecois reasons for getting out of Quebec. But I think that there's definitely a desire for people to move and migrate. And you don't have to look very far to see what's happened once COVID opened up.
There you got it.
Where are they coming from? Yeah.
Yep. And I think that's the thing. It's just, we talk about what's going on. I think, to your point, what's happening with interest rates and a potential recession is going to impact markets very, very differently. Alberta was slowly just getting out of a recession, but it still remains one of the most affordable areas to be living. And when it becomes unaffordable, people will tend to adjust. And the one thing the pandemic's done is also change the way people have worked. So people can work much more virtually now. So they're not necessarily needing to be relatively close proximity to their work anymore. And companies are accepting that. So again, places that have more affordability, I think you'll see migration trends. And I don't know. I think there might be some markets, to be honest with you, that are actually going to appreciate it and maybe not even feel the recession very much at all, which will be very interesting, right? So we'll see what happens in the next few months, right? So.
Well, and that's the thing that I pulled up this chart. I mean, this is the province's economic dashboard, and I follow these stats very closely.
Yeah.
The thing that didn't surprise me is in 2021 we had this like interprovincial negative migration, which
Yeah,
was mostly fat old white guys moving to Kelowna and Victoria, where they didn't have to deal with the cold. Like people made big lifestyle changes
yeah,
because we'd been cooped up for a year in a chunk, and now that has reversed in a very
hmm
significant way. Um, the other thing that I think is going to be the bigger driver of our rents is the international migration change, which is that the country wants to bring in 400,000 people a year, and you can't afford, especially as an immigrant who may be stuck driving a taxi cab or something or an Uber.
yeah,
You can't afford the rents in Toronto, and even in
yeah.
Edmonton. Like we do, this. We do a lot of work in secondary markets. You own a building in Devon, where's my map? Way down in the corner there. You're half an hour from Edmonton,
hmm
and your rents are stronger than in Edmonton. They're more
They're
affordable.
fantastic.
It's close to the
Yeah,
airport and Amazon and industrial. So
yeah,
people can get jobs. Like, and a lot of
yeah,
people who come from other countries will prefer small markets because of the affordability and the community and the safety that come with the small markets. So I am looking forward to a whole bunch of what is going to happen.
yeah.
On the buying side,
hmm
we're going to have some creative destruction here. There are some people who are over leveraged more on the coasts or either end of Canada, where people are already over leveraged. But even here, where there are people that have made recent buying decisions that are going to be upside down, where do you see there being, opportunities for acquisition, or is it time to dump a bunch of crap and just bail, buy
Um,
crypto?
it, well, I guess, well, I won't get into the crypto discussion because I'm just not a crypto guy, but that's
I'm
okay.
not.
But honestly, I think the opportunity is still there's going to be lots of opportunities in the horizon. If there's one thing I've learned, even shortly after the 2008 crash, 2009 crash, man, we had most of our success shortly after that. Like truly, and Chris, you were part of that too. It's just like we were buying properties at like 63, 64 a door, where today I'm flipping them for 115, 116 a door, or even 100 a door, whatever, right? Somewhere in that vicinity. But at the end of the day, they've done very, very well. Um, for my perspective is I'm getting into cash no different than what I did back then. It's like get cash ready to go. And I'm not dumping a bunch of properties or selling a bunch of properties. I'm not motivated to sell. Well, very fortunately, our properties have always cash flow, so we're not in a position that we're really too concerned. We're going to pivot. We're going to adjust. We're going to raise a lot of the rents, looking at ways to kind of maintain some of that cash flow. But at the same time, we're looking at where these markets are going to be. So, where is the best place to park it? Is it going to be downtown Vancouver or Vancouver right now? Maybe not so much because, and again, this is my own opinion on this
Mhm.
segment. But what will be very interesting is where the migration trend's happening. So if I see people
Yeah.
moving, let's say to Calgary or Edmonton, that might be a better place. And, multifamily would be a wonderful spot for that because people are going to be moving. And when things are becoming unaffordable, they tend to stay as renters at a longer period of time. And that's a common statistic. And we've seen this in the past before, and I'm sure we'll see this again. Some segments will do better than others. So, for example, in downtown Vancouver, there may be people, if people can't afford a condo or a townhome, they're going to be renting a condo versus a townhome. And same thing, if they can't rent a house, they're going to move to a townhouse, right? I think it's going to add more pressure to the rental market
For sure.
already, but can the properties itself, that's the biggest challenge that you're facing for investors trying to get to buy rental properties is based on the rents, based on the rates that there are today, is this property going to be achieving the objectives that I have for myself or not? And so for myself, I'm always in acquisition mode, always. It just may not be in the same particular market, and that's something that I've done throughout my career. And so it's just trying to be really close to fundamentals and just doing my due
Mhm.
diligence on the markets, immigration patterns, affordability, and again, where do I kind of envision opportunities? Like I see Calgary as a huge opportunity because I see a lot of migration happening there. Still very affordable. Edmonton, same thing as well. Very, very affordable. You can see even further expansion even in the Maritimes as well. It's already been inflated, but at the end of the day, the only thing that's kind of creating a little bit of a hampering there is these new regulation, new policies in regards to
Politics are
rent
crazy.
controls and
Yep.
politics getting in the way, right? And so with that being said, I think there's opportunities. And that could be opportunities even in the US. And it sounds crazy with all the
Mhm.
inflation that's going on. But there are going to be people that are struggling. There are going to be some challenging
And I
times
think
for people,
we
right?
had a good little side chat there too about there are a number of significant investment firms in Edmonton, like Alberta firms, that some of whom have pushed into the US. There are a lot of good and bad reasons why the US is
Mm-hmm.
a good place to invest. It's also a republic. States have a lot of power. So investing in Texas is a hell of a lot different than investing in Oregon.
Absolutely.
And for
Yep.
that reason, there are a couple companies like Melcor out of Edmonton has really pushed back into Ireland, into Germany, and there are Canadian companies that are looking at Europe or looking at Australia is not very investor friendly, but I do know some people there. There are some, I'm seeing that trend again of a lot of people getting back into Central America and doing development down there.
Totally.
Scares the hell out of me because I don't know anything about it. But you're right. It's an interesting time to go looking for different alternatives.
I think that's the key is like, you know what, we for people that are just getting started investing in real estate, the comfort level is right in their backyard, but that's not always the right decision. And
Mhm.
so just because you want to be able to touch it, feel it, see it, whatever the case may be, that's not necessarily the case anymore. We don't really need to do that. Like, especially with technology in this day and age,
Yeah.
like, man, we can go view the property at any point in time, and I've done that multiple different times, go doing inspections of our properties and just, having our property manager take us out for a little bit of a ride around the entire unit and just review it. I still tell people to make sure that they get out to see the property. But if you're going to go to the States, you're going to go to Mexico. Chris and I were talking about like investing in Europe and earlier today. This is like, hey, this could be a great business holiday type of expenditure where you can explore as long as the numbers make sense. Because
Mhm.
the way the business is being managed, for me, I'm based in Vancouver. I got properties back east. I got properties in Alberta. It's really no different. The only true difference is, maybe a little bit further out. Obviously, we're not talking taxation and all these policies and stuff, so I'm not going to be very
Yeah.
clear. I'm just talking about the business in totality or in general. But it's still being managed in a very similar fashion, right? So
I like it. Well, I want to ask one other question that's kind of came up in the context of pipe bands and teaching kids to
mm,
play the bagpipes, but I want to kind of goes the other direction from your last comment, and I'll make that our last thing so this video is not
sure.
17 years long. Um, I think when it comes to small buildings in small markets,
Mm,
um, that there are a lot of people that we both talk to and that we know who live in small towns. There's an old Rain member friend of mine named John Peacock who lives in the small town of Rimby. Rimby is like, whatever, 5,000 people. All of John Stuffins in Rimby. He does a great job. He self manages. And I think that for a lot of people who live in small markets and have the ability to self manage, they bring an opportunity like in this high inflation, high cost environment because they can do the work themselves. They can use
yeah.
alternative supplies. You can pick up a discount sink at Rona. Um, I mean, as much as you don't want to be out there, I mean, I don't want to imagine you with tools in your hand in your buildings. I don't know that would go well, but there are a
No, it
lot of
wouldn't.
people who are in the area and have the ability to run it themselves. Thoughts about that? I mean, you coach a lot of people on that topic.
Yeah, like I think it goes right back to it is like what's the long-term strategy for you as an investor? If
Mhm.
you are wanting to own a few properties, be it smaller units like you've referenced, and you have the ability to manage it yourself, why not? Like it makes sense.
Mhm.
And Chris, you and I have been around the block a few times. It's just like, my perspective is it's better to own less quality investment properties than being the next I don't know who I would use. I don't like using terminology, but I'm using it anyway. Mr. Donald Trump, where he's got this massive real estate portfolio,
Yes.
and just for the exercise of a swollen head. And no offense, it's just like sometimes it is better to have less than more, right? So,
I have
and so
this
I think,
post-it. Yeah. You go ahead.
yeah,
I'll show you the post-it after.
yeah. So I think that's the key is like, what's the objective? What's your goal? And so, ask yourself if your investment goal is to make $5,000 a month cash flow out of your property and you're able to do that self manage this and you own a few smaller buildings to facilitate that, Yeah, that's perfect. There's nothing wrong
Totally.
with that. That's great. But if you are trying to buy like 15 or 20 apartment buildings, and you're really trying to scale it, um, your full-time job is going to be managing those properties, and it becomes a lot more challenging from that perspective. So it really goes back to what it is that you're trying to accomplish and what your goals are. And if you're able to accommodate that with less properties, and that's my opinion, giddy up.
I
Like that's
completely
better. That's,
agree.
it's about having it's more time to do the things that you want to do
Hmm.
versus spending all this time and energy dealing with real estate, right? Real estate's just a vehicle to get you to your goal at the end of the day. Nobody really wants 1,000. I don't want 1,000 doors. Are you crazy? Like it's just, that's
No,
way too
totally.
much work for me. I don't have no interest in this. Even though we've delegated all this stuff, it's just, I like, even though we've got a very big portfolio, I'd like to keep things nice and tight and simple. And if I could accomplish the goals that I've set for myself with a smaller portfolio, that's what I'd love to do.
So this is a quote I keep on my wall from a friend of mine. Mason's a multifamily broker like myself, kind of in the Pacific Northwest. My life is about optimization and simplification, not accumulation. And I think that's
Hey,
something I've been doing with a lot of my clients right now, especially as rents are starting to go up, expenses have gone up a bunch, we've got interest rates going up, is helping them do a 360 on their portfolio and
mm-hmm.
saying, which things can we improve, which things are not improvable, and where can we cut it off? Can you make the same amount of money with a smaller portfolio?
Yeah,
Can you get your life back? I think that people in small towns have a chance to ensure impeccable property management where they're an alternative option. Hire it out if you can, do it yourself if you can. But for people who are looking for bigger properties, I think you hit the nail right on the head, which is that they need to ensure that they start with a goal that they can align the types of properties they're acquiring so that there's, things are properly ordered,
yeah,
that they're growing in the right type of way. So when something like a 1% interest rate change happens, they've got enough, they've got all the other components of their business going in the right direction so they can deal with that as one issue, and they're not having to continuously juggle all the other problems.
yeah. Exactly. That's exactly it. So
I like it. I'm entertained. Well, I'll let you go, Mike. We're going to wrap this one and come back, I'm sure, another time to talk about other stuff.
love it. Great to see you, Chris. Happy birthday again, buddy. So
Thanks very much. I get a bigger hat. Thanks, Mike.